Hey everyone, today we're going to talk about our debit and credit rules. Now that we've made it through chapter 1 and we understand how to analyze and record basic transactions underneath that accounting equation, now we're going to learn one more additional step. So all the information we learned in chapter 1 carries forward, and we're going to add one more step, okay? And those steps are knowing whether to debit an account or credit an account. Before you can know that, you need to learn your debit and credit rules. So give me just 1 second, and I'm going to share my screen with you. Okay, so first of all, what do you think the words debit and credit mean? Just think about it for a second. What about the word debit? Positive or negative? Most people think about the word debit having a negative meaning because when we use our debit card, the bank takes money out of our account. What about the word credit? Most people grow up thinking about the word credit as a positive because when you make a deposit or somebody's adding money to your account, they say, we will credit it. So the best advice I have for you at this point is, unless you have had an accounting class, then just forget about what you think you know about the meaning of those words, okay? Recording transactions using these rules, y'all are gonna love it. You know how you didn't really like that recording them underneath the accounting equation because it was long and messy and it didn't fit on your paper. Debit and credit rules make that much better. And the last thing is, I want you to just memorize these rules. I know we don't use the word memorize very often in accounting, in education in general, but I want you to memorize these because you're going to learn them, which is what we really want. But you have to use them to learn them, and to use them, you need to memorize them. So just trust me and go ahead and memorize these rules. Second thing, let's look at this box down here that says T account. Okay, inside that box, you see what? A capital T. So this is not hard. These are called T accounts because they look like a T. Let's talk about the meaning of the words debit and credit. As you see down here, debit is on the left side of the account and credit is on the right side. Honestly, that is the only true meaning of the words debit and credit. Debit, left side of the account, credit, right side of the account. No positive, no negative. Now, if we take the word debit or credit and we use it in association with a particular type of account, then it takes on a positive or negative connotation. So let's look up here. Notice I have the accounting equation. Assets equal liabilities plus equity. Underneath asset, we see a T account, D for debit and C for credit. Assets are increased by debit and decreased by credit. So now that we associate the word debit with a particular type of an account, in this case asset, debit means increase and credit means decrease. Now look at liabilities. Liabilities are decreased by debit and increased by a credit. The exact opposite of assets. So why do they have the exact opposite rules? Well, think about it. They are on opposite sides of the equation, so they have opposite rules. Our debit and credit rules are simply a system of pluses and minuses, positives and negatives, that keep our accounting equation in balance. That's all they are, okay? Now look at our equity. Our equity is decreased by debit, increased by credit. So our true equity accounts have the same rules as our liability accounts, which are the opposite of our assets. So why would liabilities and equity be the same? That's right, because they're on the same side of the equation. Now, we know that we can break equity down a little bit further, and we know that revenues and expenses, our income statement accounts, affect equity. Revenues make equity go up, expenses make equity go down. So if I want to break them out into their own categories, which we will do from this point forward, revenues are decreased by debit, increased by credit. The same as our normal equity. Expenses are increased by debit and decreased by credit. The opposite of revenue. Well, think about the effect they have on equity. They have the opposite effect. Revenue increases equity, expenses decrease equity. So they have the opposite rules. Our quote, normal equity account is the owner's capital account. And we know that capital is where we record investments, and investments and revenue are the two things that increase equity. So therefore, they have the same rules. Now, if you look over here at all these words, those words are just what I was saying to you. The words are the same thing that we have over here in the graphic. The rules are the rules. I'm going to show them to you several different ways. Excuse me. Whichever way makes the most sense to you, use that to look at and learn. Okay? I love this little sheet on debits and credits. This is strictly words, no T accounts. Assets are increased by debit, decreased by credit. Liabilities decreased by debit, increased by credit. Notice all the increases are blue and all the decreases are reddish pink. So maybe this way helps you learn them. Great, use it. And then finally, I have another graphic with T accounts, and I've got it broken down even further. I have assets, liabilities, capital, drawing, revenues, expenses. So instead of having, quote, an equity section, I have all four things that affect equity listed out separately. We know that capital, where we record investments, and revenues increase equity. And we know that the owner's withdrawals and expenses decrease equity. So notice something for me. Capital and revenues have the same rules. Drawings and expenses have the same rules, right? The two things that increase equity are increased by credit. The two things that decrease equity are increased by a debit. Opposite rules because they have the opposite effect on our accounting equation. Okay, think about it. It makes sense. You just got to give it a little time. One thing new on this slide, I have a box under each category, each type of account, each part of the accounting equation that says normal balance. Do you notice anything about where those normal balances are? Which side are they always on? They're not always on a debit or a credit. They're not all debits. They're not all credits. What's similar? That's right. They are all on the increase side. Whatever increases an account is its normal balance. So the normal balance of an asset is a debit. The normal balance of a capital account is a credit. So really nothing new, no additional information to learn. If you know the increases, you automatically know the normal balances. Let me stop sharing my screen. Okay, so let me know if you have any questions. Like I said, all of those graphics had the same information. Guess what? There's some graphics that are even different in your textbook. And if you will look in Canvas in our Chapter 2 module, you'll see a document that I have posted in there titled Debit and Credit Rules that, guess what, show it in even a different way. So I'm trying to give you a lot of options. I don't care which way you use to memorize your rules, you're memorizing the same information. So pick one and learn them, okay? Thanks for watching, and let me know if y'all have any questions. See you soon.